Hi, I'm Ben Reppond. Today is September 20, 2022. Welcome to my YouTube broadcast. Today I'm going to do something that I've done in the past. 6 weeks ago I covered the Shemitah year. I'll explain later. Also earlier this year I covered it. So this will be the third time. The reason I'm doing it right now is because we're at the very end, the last week of the 7th year, which is the Shemitah year in or on the Hebrew calendar. Let me give you the context for those who didn't hear previously. The background to this is early in the Hebrew culture, it's explained in the Torah for the Jewish people and in the books of Leviticus and Deuteronomy for the Christian Bible, the Old Testament. And it was a way that they dealt with financial hardship, financial crisis. And what would happen is that people would fall into debt, and they didn't have a way in that agrarian society to deal with debt. And if they didn't deal with it, people just stayed, they would become indebted to or indentured really to the person that bailed them out, and they really wouldn't have a way to get out of it. So in the books of Leviticus and Deuteronomy, God gave a way for them to get out of debt. And what would happen is every 7th year, and that's just not every 7th year, but it's a specific 7th year on the Hebrew calendar. On that 7th year, they were to forgive the debts of people that they had loaned money to who had not completely paid them back, give them their freedom, and in some cases, to even help them, give them some land that they could, so they wouldn't fall back into debt. And so it was a way of, it was a manner of release, and that's, or remission, forgiveness. And, but it was also a period or time where there was reset. So that was the background. The second thing in that was that they were to let the land rest. So it was kind of a release for the land. Let the land rest that 7th year. For people who raise crops, they understand that you can't just farm the crop year after year after year without giving it a rest. So periodically you need to give the land a rest so it will become more productive or retain its productivity. And so that 7th year that's what they were to do, is to give the land a rest, a Sabbath for the land, and then also forgive the debts of people during this 7th year. And so really it became a period of rest. The way of making a living was through the land, and if the land rested, that means they basically didn't have a job for a year. And so it was at times very difficult. But as you fast forward this into our culture, we're of course not an agrarian society, and we have banks and credit cards and so forth, ways of accessing debt. But it's still, the concept is that we become enslaved to debt if we have debt. What has happened is that the pattern has been studied very carefully. Jonathan Cahn did it in his book, The Mystery of the Schmeida, where it's observed that the stock market, and in some cases the bond market, has a collapse, kind of like in ancient Israel. A collapse, a bringing down of the economic system, the financial system. And that has happened in the past 100 years. I've gone back 91 years, and 12 out of the last 13 Shemitahs have been stock market or bond market crashes or severe declines. So there is a correlation, there is a pattern. The reason I'm covering this today is because we are entering or have entered the last week of this 7-year cycle. Historically, with the U.S. stock market in particular, the crash or the collapse in that Shemitah year, that 7th year, happens in the last month. And the last 2 times, it's happened in the last week. And here we are entering the last week. As I look back over the past month, just say the last 30 days, I did a calculation. Over the last 30 days, the stock market, the S&P 500, has dropped 10%. That's a lot for a month. 10%. The bond market, I'm going to use the 20-year government treasury bond, has dropped 11%. This is not supposed to happen. The bond market is supposed to, in most cases, go up when the stocks go down. Didn't happen. So they both came down, and they have come down in the last month severely. So I'm bringing this up just to, and I've been saying this for a year now. I've been going back early this year and even into last year when I was doing my webinars. I was saying, be cautious. This is a Shemitah year. Be cautious. Be defensive. And, you've seen what's happened this year. It caught a lot of people by surprise. The traditional financial advisors do not believe in protecting that kind of risk by getting out of the market. One way to deal with it is to get out of the market, just get out of the way. This year, that strategy would have worked very well, even though the market went down some and then up a little bit and then down some. Overall, it's gone down. And as I said, this last 30 days, down 10%. So that would have worked very well, but traditional financial advisors don't believe in that method. They believe in a methodology of allocating stocks and bonds, and then a very minor amount to some other assets. And that is the traditional model. It's called a 60-40 portfolio, a buy and hold portfolio. I call it a traditional portfolio. And they don't believe in doing anything more than that. They just, if it's going to collapse, let it collapse. Let it go all the way to the bottom. Meanwhile, and I've had calls from people really frustrated about this, very angry, upset with their financial advisors who have done nothing. And they've talked to them and said, do something, do something. And they've done nothing. Meanwhile, they actually have the audacity to charge them a fee. People have lost, I've talked to people who have lost tens of thousands, hundreds of thousands of dollars, and they pay a fee to an advisor for that. Can you believe that? It just seems crazy to me, but that's the model, is you just let, if it's going to collapse, you just let it go all the way to the bottom and keep charging a fee. That's the traditional model. We don't do it that way. We use a tactical approach. We've always used a tactical approach of getting out of the way of declining markets. And in a generally uptrending market, it doesn't look a lot different than traditional portfolios. Attractive rates of return, everybody gets an attractive rate of return in an uptrending market. You haven't proved anything. But when the market turns and goes down, that's where this particular methodology has paid off, where we have been out of the market either partially or completely most of this year. And that's called tactical investing or active management. But the traditional model does not believe in that. The traditional model, the buy and hold portfolio, asset allocation, 60-40, was developed, it's also called modern portfolio theory, developed by a guy named Harry Markowitz in 1952. And he as he developed it, he explained, he said, this is not intended to be a method for investing. This is intended to be a method that explains non-correlation, but don't use it for investing. What happened? The business schools, they didn't have any other way to tell people how to invest, so they adopted it against his recommendation. And now it is taught as fact. This is the way you do it. And a lot of people, perhaps you, have buy and hold portfolios, asset allocation portfolios, and they all stem back to that original thinking of Harry Markowitz in 1952. Well, first of all, it shouldn't have been done that way, according to Markowitz. And secondly, we've grown way beyond and much different market environment than in 1952. Traditional buy and hold 60-40 portfolios do not work. They do not work in all market conditions. They work okay in some market conditions at some times, but that's not good enough for a one-size-fits-all portfolio that's good for all seasons type of investing. They certainly have not worked this year. And investors have been betrayed and very frustrated at this kind of methodology, and yet the people who are behind it, they bend over backwards trying to, I say they kind of twist themselves into knots, trying to explain how it somehow is okay. I've read some of the commentaries of advisors who use these methods, and I read it and I go, I don't even know what they're saying, but you're just trying to say something that says, I'm okay, stay in your seat and pay me my fee. That's what they're really saying. But anyway, I just want to point this out, that this is a Shemitah year, and we're in the last week, coming into the last week of the Shemitah year, which will end on September 25th. It's part of the lunar calendar, and we're on a solar calendar, so we don't tend to think in terms of the lunar cycle, but this will end this particular 5782 this year of the Hebrew calendar, and then on the 25th begins the new year, which is the celebration of Rosh Hashanah and the going into the next cycle. I want to play a video for you. This is a brief clip from Bloomberg, and this is where Romaine Bostick interviews Mark Cabana of Bank of America and Maureen O'Connor of Wells Fargo about the future rate hikes of the Federal Reserve and the impact of those rate hikes on the economy. And take a listen to this.
At Bank of America's Mark Cabana joining us right now. And Mark, let's start off here with how surprised were you not only by the inflation print, but more importantly by the market reaction to it?
Sure. Well, thanks for having me. We were surprised by the inflation print. We thought that inflation, both in services and goods, were going to be on a downward trajectory. And what we saw is that they're both remaining persistently and stubbornly elevated. That is true, again, on the goods side and on the services side, especially with that alarming OER print, or owner's equivalent rent print that we saw. And as a result, it clearly means that the Fed has to do more. Yeah, so the B of A house view is that the top of the range will be 4.25%, so 4.25%. But we acknowledge that the risks are skewed to the upside, given the strength that we're seeing both on the inflation data and also in the labor market. And as long as these two variables both remain quite strong and quite elevated, then the Fed is going to probably have to keep going. Now, again, the risk here is that the Fed is just reacting to the data that they see right in front of them. They've probably lost their confidence to have a high degree of conviction in where inflation and where the labor market is likely going. That means that they're reactionary, and that increases the risk that they will likely go too far. But given where the labor market and inflation are right now, both pointing to signs of imbalance, the Fed knows that they have to err on that risk. And if it means going too far, then so be it, because they know they've got to get inflation under control.
And second guest is now with us, Maureen O'Connor, joining us right now, Wells Fargo Global Head of High Grade Debt Syndicate. And of course, Mark Cabana still sticking with us. Maureen, let's pick up where Mark left off here. Give us a sense here of where you sort of model where the Fed can end, and more importantly, can they end in a place that doesn't cause, I guess, that proverbial economic destruction?
I think I agree with the points that Mark was making. I think that the needle that the Fed has to thread here has grown increasingly fine, and the likelihood that they're going to be able to orchestrate a soft landing here, I think, is sort of a fleeting hope at this point. So we do price in the likelihood that we are going to be looking at, some stronger recessionary headwinds as we head into 2023. We have a stubbornly high inflation problem. The Fed is going to have to continue on this path of very aggressive rate hikes and aggressive balance sheet unwind. And that's going to be a drag on all risk assets. Obviously, you saw the market reaction to the CPI print on Tuesday of this week. But we continue to see headwinds abound, and that will be impactful to both equity markets as well as credit product like I operate in an investment grade.
Now, they were referring in the video to, and particularly Bostic was referring to the fact that this year, 2022, yields, counting this current Fed meeting and the coming Fed meetings, are probably going to get to 4% on the overnight bank rate from the Fed. 4%. He even uses the term 4.5% or beyond. I saw this piece in Reuters and in Bloomberg that from Ray Dalio, and I read the text on it, and he said, I did the math. Okay, I didn't do it, but he said, I did the math. Rates, if the Federal Reserve rate is at 4.5%, that would sink stocks by 20%. Now, what he's saying is we're already at 20%, about. Some portfolios are down 25%. If you were lucky enough to have a portfolio down 15, you'd probably be a winner. But stocks are, generally speaking, down about 20%. Let's just say that. What he's not talking about that. He's talking about another 20%. So if we go down another 20%, that gets the stock market and probably portfolios down about 40% from their high in late 2021. This starts to amount to a crash. And so far, I would call the 20% decline, it's a decline. It's been a negative year. It's a negative market. And it's particularly a negative bond market. But here he's saying, if the Fed raises rates, and they're talking about it, about the idea that they're going to raise rates aggressively enough to deal with inflation. The good news is they will deal with inflation. The bad news is they're going to tank the market, and they're going to tank the economy, according to Dalio and others. Now I want to play a clip from Joe Kernan, CNBC. He is interviewing Ed Yardeni and Rick Santelli. And again, they're talking about the same issue of rate hikes and the impact of those rate hikes on the market. Take a listen.
I think what we have to do is focus on the reality. What are they actually saying? What are they actually doing? And then make our investment conclusions based on that analysis. And it seems to me that they are committed to raising the interest rate significantly at this meeting next week. I do think they're going to come around and conclude that maybe just get it over with, maybe 100 basis points instead of 75 basis points, and then maybe one more hike after that. I mean, they know that monetary policy operates with a long lag on the economy, but they've got a credibility problem, and they're trying to get ahead of it. Actually, they're trying to catch up with the 2-year Treasury note, which is saying that within the next 12 months, or a lot less, we'll be at something like 3.8%.
Stephen, I've got a couple of my colleagues here, and Santelli's a little older than Leisman, but Rick, can you remember where both sides were so certain of and neither one is a good outcome, an economy on the precipice of a recession and a Fed that needs to go 1 to 2 points at a time? Both of those, they're polar opposites. I don't know if I need to say polar. They're opposites. Do you remember the last time we had this sitch?
No, it is a rather unique situation. And what makes it even more unique is, and I like what Ed said, and he probably doesn't remember, but in the 80s, we saw a lot of this. He was at Drexel, I was at Drexel. Things have definitely come full circle. But if you look at Fed fund futures right now, the November 22 contract all the way to Feb 24, all of those are making new contract low prices as we speak. 16 contracts, okay? So they're getting Powell's message loud and clear, and his message is hard to argue with. I can't imagine he's going to go less than 3/4 of a point. But the problem is, and Mr. Sterling had it to some extent, it's not housing. The Fed certainly knows that they were going to definitely throw grenades in the housing market. I think about Eurozone inflation just released, year-over-year CPI up 9.1%. The pound at the lowest level since '85, the dollar very close to fresh 20-year highs. It's the global recession that somebody needs to pay attention to, Joe, because the United States is big enough that we're going to leverage the rest of the world down.
And then finally, I want to play one also from CNBC. This is Scott Wapner, who's interviewing Avery Sheffield, and her view of the market reaction to the rate hikes and what's going to be the impact on the economy. So take a listen to this.
Joining us now, Avery Sheffield, co-founder and CIO of Vantage Rock. Welcome back. It's nice to see you again.
Pleasure to be here.
Let me just get your reaction quickly, since I have you here, to what FedEx just delivered, pardon the pun. I mean, it doesn't make you feel all that optimistic about the economy at this moment.
No. And, this is something that we've actually been anticipating because, as you well know, we follow the consumer sector very closely, and we've seen this massive inventory build so much earlier than anticipated. Certainly has led to a tough promotional environment, but also we've anticipated that this fall, we're actually going to see a lot less demand for deliveries because companies were bringing in goods so much earlier, and that would lead to, a meaningful decline in rates. And then also, of course, we've seen e-commerce growth be slower than anticipated. So with capacity expansion, that leaves less opportunity for pricing increases than we've had in the past.
Yeah, so it does play into your overall thesis about the market. We did suggest you think we're going a fair amount lower?
I think that certain stocks have a lot further to go, and that many stocks, maybe all stocks, will be pulled down somewhat with it. I think that there'll be some great buying opportunities, but I think what I don't feel is as widely discussed or thought at this point is that there are a lot of companies out there that will never get back to maybe even the levels that they're at today after a further decline. That many conversations are about, when do we buy? Like, how do we get back in? The market's going back up. Certain stocks I do think are oversold for the long term, but others are very much still dangerous to get involved in.
What kinds of stocks are you specifically talking about here?
Right. So growth stocks, a lot of stocks even in sectors like the software sector that have very high valuations that have traded on non-GAAP earnings for many years. Maybe they have a good business, but not necessarily a good business model in terms of generating real returns. And I think that as we start to see slowdowns in these companies, there's a lot of risk and a downside ahead.
I interviewed Brad Gerstner of Altimeter earlier today. He suggested there's maybe 70% of those kinds of companies that will never see the light of day to where they once were. That 30% may get back. They'll, in his words, I think he used the word grind. They'll grind it out and they'll get back. But 70% of those stocks which were once overvalued and came down a lot may not get back to those levels ever. I
would agree that it seems like it's probably at least 70%.
Okay, now shift gears. I want to go into, I cover this every week, the flow of funds report. So what we see is the stock market does one thing, portfolios do one thing, bond markets do another thing, whatever. We see all of this, but what we don't see typically, what's not obvious to us, is what's going on behind the scene, what's going underneath the obvious. And that is more, it's telling where money is going. So it's usually coming from somewhere and it's going somewhere. And it gives you, again, it's in the rearview mirror, but it gives you an indication of where things are going in the stock market, bond market, and money market. So this is my third week of saying the same thing. So this is interesting. Conventional equity funds had net outflows. In other words, there was a net reduction in equity funds of $14.5 billion. Now, it's a multi-trillion-dollar market, so it's not a lot. But it's showing that there is movement out of equities. Well, that didn't surprise me, because last week was a down week. This past month, a down month. The market was down 10%, stock market down 10% for the last month. And every day last week, the market was down. So no surprise. But the next one, this is not supposed to happen. Bond funds had net outflows of $5.3 billion. Very odd. I've covered this before. Very odd for them both to be going in the same direction, but they are. And what's equally as puzzling is money market funds. Now you're thinking, okay, the money's coming out of the stock market and out of the bond market. Okay, people are going to park it over in money market funds. No. Money market funds had net outflows of $12.3 billion. Money market, equities, and bond funds, all net outflows. My question is this: where is the money going? It's either going in a can in the backyard, or it's going into precious metals, or some form of commodities. Maybe it's in other currencies. I don't know. I just don't know. It just seems very odd to me that it's not going in one of the places that we would expect it to go. Okay, this is the dashboard from Friday, and it shows the major the indexes that I want to follow, and I'll point these out to you. And going on the left side is their ETFs. So going from the ETF, the name of the ETF, and then the percentage change for that day, the week, the month, the quarter, and year to date. A lot of information right in one place. And then on the right side of the chart, for averages, 20, 50, 100, and 200-day moving averages. So where is this index relative to those averages? When a stock or an index ETF is below its moving average, it's generally not a positive sign. It's going down. Well, it's not a positive sign. And so here you see, I'm listing 7 indexes, assets, indexes. All of them are below every moving average. The 20, 50, 100, and 200-day moving averages. Very unusual. It's also very unusual to see them all above. But usually it's mixed. Last week there were 7 out of 28 that were positive. The rest negative. This week, I told you, the week was a negative week. So the past week. All of them are now, as of Friday, are all below all moving averages. Quite significant. These include, going down the list, the Dow Jones Industrial Average, S&P 500, the Russell 2000 Small Cap Index, emerging markets, developed markets, NASDAQ 100, tech heavy, and the 20-year government bond ETF. They go from 15% down, 18% down, 19, 22, etc., all the way down. You get down on equities, you get all the way down to the NASDAQ 100 the one that was the biggest winner last year, the darling that everybody loved, down 27%. And then guess what? Government bonds down 27%. That is what is causing devastation, or bond funds correlated with that are causing devastation to portfolios. When you think bonds are going to help me in this kind of market, no. The 20-year government bond ETF is worse than all of those averages. When we take the S&P 500, the broad market, the 500 largest companies in the U.S., and we break those apart into sectors, we can see that there are 11 sectors in the U.S. economy, all types of businesses. And they go from energy, consumer staples, healthcare, etc. Going down is the same thing. We're looking at the week, the month, the quarter, and the year. So as we look at the fourth column, that's the numbers for the year. We can see that the energy ETF XLE was up 41% for the year, and all the other sectors inside of the S&P 500 were all negative. As we go to the right of that, I'm looking at those same averages. Just trying to, as a dashboard, trying to get a sense for what's going on in the market. I don't view it as predictive or anything. I just see it as it's a snapshot in time of showing what has happened and where things are. And what you can see is that the energy ETF on the top, XLE, is above 3 of its moving averages. And then down below, consumer discretionary is above 1. All other sectors and all other averages, these ETFs are below all of the other averages. When I go into the charts, this is the S&P 500 represented by SPY, the exchange traded fund for the S&P 500. This is a one-year chart. It's a weekly chart showing one move equals 1 week of movement from the beginning of the end of 1 week to the end of the next week. And you can see that over that 12-month period for about, 7 or 8 months, that the S&P 500 has been on a decline. Generally speaking, that's why I drew the black arrow. Generally speaking, the S&P 500 the movement is in the direction of downward. And that last move down represents this past week. The S&P 500 is broken into two broad categories. One are growth type stocks and one are value type stocks. There are ETFs that track each of those. One's called SPY-G for growth and one's called SPY-V for value. And they contain the stocks in the S&P 500 that fall into one of those two categories. So it tells you how they are doing. And then I plot those on this line, the red and black line that goes along the way, and that's a ratio. Growth is the numerator, value is the denominator. And so if it's going down, that favors value. If it's going up, that favors growth. Which one is in favor? So in my opinion, that's helpful information to know. That's one of the components that we use when we are invested in the market, that we use for determining where we need to be, is that ratio. The black arrow shows the downward direction of the S&P 500 for growth stocks. Growth stocks are out of favor, going down. Value stocks, therefore, are in favor for the past 9 months or so. So that's That tells you that, generally speaking, if you're going to be invested, which I don't think, at least we're not invested. So if you were going to be invested, you would want to be more invested in value. They're both going down, but value is going down less. So on this slide, it's a ratio. The chart, the red and black line, plot the ratio of the small cap index, the Russell 2000 small cap index, to the S&P 500. So this shows that with the Russell 2000 IWM as a numerator and SPY, the S&P 500, as the denominator. What this means is that if it rises, it favors small cap stocks. They're more in favor than large cap stocks, generally speaking. And when it goes down, as it has been doing for about the last year and a half, it favors large cap stocks. Now, we know both large cap stocks and small cap stocks both declined quite a bit. But this shows the magnitude of decline of the small cap being higher than the large cap. And you can see at the very end, not really a decisive pattern, I guess you could say, still declining. But S&P 500 large caps are just, relatively speaking, declining less. Now, this is not a relative chart. This is an absolute chart. So we're going to switch from ratios to absolute. This is the long-term government bond, the 20-year government bond represented by the ETF TLT. And it's a 30-month chart, so a 2.5-year chart, because I wanted to bring into view, the degree of decline of the long-term government bond. So you can see, you go back into last year, you can see the decline, or actually this goes back into 2020, the degree of decline of long-term government bonds, a very sharp trajectory down, then a recovery, and then another collapse. The arrow on the right shows the degree to which bonds are collapsing this year, 2022. Remember, I said this is the asset that is supposed to go up when stocks go down. This chart is not in the playbook. Financial advisors have not looked at this. They don't want to look at this. I think their opinion is they don't believe this can happen. And it happened. Why did it happen? It happened very simply because interest rates went to zero. And they stayed there for quite a while. Where do you think they're going to go from zero? They're going to go up. When they go up, bonds are going to go down. Now, they could go down at a time when stocks are going up. That's entirely possible. But they could also go down when stocks go down. And that happened this year. But either way, bonds have got to go down if bond yields and interest rates go up. And yeah, it was this, and you see the end of that chart. You can, I just told you that for the last month, and that shows it. The last month, down 11%. Gold. Gold is generally speaking in a downward trajectory represented by the black arrow. And it has had a few weeks where it has gone down every week. The general direction and the short-term direction is down. That was preceded by a period of time when it went up quite a bit, but then it just turned around and corrected. So that's gold represented by GLD. Now I'm going to bring it down to an 18-month chart to show you silver. Silver is interesting because it has had the same downward trajectory, but last week it slightly went up, and this week it went up a lot. So that's interesting. That silver, which is usually correlated with gold, silver went up a lot. This week, gold went down. Very interesting. And So, but it still is in a longer term, intermediate term trajectory down. Then I plot these two, GLD and SOV. I put SOV as the numerator, GLD as the denominator. And so when it is going down, it favors gold, and when it is going up, it favors silver. So this week, particularly because SOV went up and GLD, gold, went down, it had a very sharp rise up favoring silver, which you can see at the very end. The volatility index, the VIX, VIX, represents the degree of volatility, particularly higher volatility in the market. So as equities go down, particularly if there's a sharper downward decline, then this tends to go up. And the line at 24, which is my artificial number there, of when it's above that, we're in a riskier period, and below that, risk tends to be lower in the market. So that has now risen, so it's above 24, and is signaling that we're in or entering into a period of higher volatility. Asbury Research does their metrics measuring market conditions. No surprise, at the end of last week, all 6 of their indicators were negative. What was interesting was that the previous week, which had some positive elements to it, only one of their indicators was positive the week before. So here all 6 have turned negative. They have not updated their data on the next 2 charts, so I'm just going to spend a brief time on these. This is from the previous week ending on September 9th, favoring which ones are doing better than the others or less worse than the others. Stocks over bonds, high beta stocks over low volatility stocks, S&P 500 versus Dow, and the U.S. markets versus the emerging markets. And then on the bond side, high yield over high quality, and short term over long term. So these don't have a read for you this week, but that's the view. Now, all of these, everything that's in green is negative. What it's compared to is also negative. So everything is negative. So when something does better, enough better that it gets a green box, it just means it's doing less worse. And the same thing on the U.S. versus the world. There were only 2 countries that had better performance. Again, this is a week before last. Better performance than the U.S., and those were New Zealand and Brazil. And again, those were down, but they were down less than the U.S. The Buffett indicator measuring the ratio, measuring the stock market by the economy. The stock market being the numerator, and the gross domestic product, the economic output, call it the economy, being the denominator. And so that ratio is now 167%, which is considered, the box at the top, is considered overvalued. So while about 20% of the market has declined in value, being the numerator, it is still elevated. With a 20% decline, still elevated. And the ratio is high, it's 167%. Last week it was 175%. So not looking good. And so the value of the stock market is 41 trillion. The annualized gross domestic product is 24 trillion. The price of gold, these are the spot prices of gold. This is not the ETF. So the spot price of gold, as I told you in previous slide, declined 2.5% from the previous week. The spot price of silver rose 4%. Remember seeing that sharp end of the chart where the ratio went up so much favoring silver? This is why. And so when I say spot price, that does not include the markup. So when you buy from a retailer, which is how we buy, they add a markup or a premium to that. And this does not include that premium. Finally, I want to come back to what we started with, the Shemitah. This is the Shemitah year. It ends this week, the end of this week. And it is the period of reset, of release, of collapse. And the patterns in ancient Israel are carrying forward into equity markets and bond markets all over the world, certainly for the last 91 years that I measured, and an interesting pattern. What does this mean to you? I want you to just think about what you do. What do you do with your investments? What choices do you have? Because traditional investment advisors have, in my opinion, and the opinion of a lot of people I talk to, done a very poor job of managing this risk, locked into an old style methodology that has not worked. You may have to think for yourself. You may have to maybe get out of the box a little bit and realize what's happening. And, you know, I realize that the market and financial matters are not everybody's area, but if you see your portfolio in serious decline, I would just encourage you to think, start to question what is happening. Because, as Ray Dalio said, if they bring interest rates from where they are now up to 4.5%, that's not a long stretch. He sees that equity markets have risk in them equal to about another 20% decline. Are you okay with that? In a portfolio designed to ride it all the way to the bottom. I'm just trying to give you information and get you to think. Thank you for watching. If you have comments or questions, leave them in the comment section below. I'll be glad to respond to them. And feel free, if you want to, reach out to me by phone or email. Thank you again for watching.